12 hours, now actually 24 hours because we have the boot camp studio down in the West Village. So we stream 24 hours of live television content around the world every day. We have 10,000 classes on demand, so it is a media company akin to a Netflix.
For you, Jeff in Atlanta wants to know, is Peloton going to 175, trading at about 114 right now?
Ooh, I mean, I hope so, but I don't think it's going to be this year. As you mentioned, they're trading at about 114 right now. The highest they've hit in the past year is at 171. So I think it's going to be hard for them to hit 175 this year. But they're making investments into manufacturing, logistics to get customers their bikes faster. And they also, this is still a hybrid trade for me, right? It's not reopen versus stay at home. They've got a high retention rate compared to traditional gyms for customers. They're doing 1 million.
135% in 6 months, 268% year to date.
It is. And when you look at the backlog of people who want this product, it's unbelievable. My sister, actually, I got a Peloton more recently, a treadmill. And my sister was like, Courtney, I love this thing so much. I want one too. She went on to try to buy one. She can't even get one until December. That is not a stay at home product. It might have catalyzed kind of their growth, and it created a tremendous amount of growth. But this is a product that is going to be here whether you're going to the gym or not.
Shares meet time of Peloton finishing lower today by 8.5%. The company revealing in last night's earnings that it plans to slash the price of its original bike by about 20%. But our next guest just reiterated his buy rating on the stock, saying it's unwise to sell Peloton shares following this price cut, just as it would have been unwise to sell Apple when it cut the cost of the iPod 12 years ago. Joining us now is Daniel Adam from Loop Capital Markets. Daniel, let's just quickly delve a little bit into that comparison. Obviously, Apple was going to go on to create the iPhone, and it's in a billion pockets right now. And Apple probably was trading at a much lower valuation than Peloton is. But what are you really getting at when it comes to why you think investors are being short-sighted to be concerned about the outlook for Peloton right here with this price cut?
Yeah, it's a fair question, Mike. I think it really boils down to the fact that lowering the price increases your addressable market. That's what Apple has done. That's what other technology companies have done historically.
Peloton had I've got to hand it to Foley. I think he's a very bright guy. They had some remarkable numbers. People will swear by this. It was a winner during the pandemic, and it's staying a winner. And I know what happened with the treadmill is bad. And I love the fact he started his letter by saying, "Look, I screwed up. I apologize." Yeah. He didn't say, he didn't make it someone else apologize, or we made a mistake, or mistakes were made. He owned it, but connected fitness workouts up 239%. Total revenue growth up 141%. Carl, this is a magnificent quarter.
It's good to have you. It sounds like you agree with Cathie Wood, and that is investors are sort of missing the big picture on some of these so-called stay-at-home names. Which ones would you suggest?
I do agree. Thank you for that shout out on the Citizens deal. That's brand new. There are some names of the high multiple, fast-growing winners from the stay-at-home that have been equally afflicted this year. I'll put Peloton as one of those. That stock, as you show, is down 70+% from its peak. But connected fitness and that product being the best in class, I think, is one that has far more durability than just being a stay-at-home product. And that's one that I put right up there.
All right. Today is Thursday, January 20th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. Where do we start, huh? How about this? In focus tonight, What a bloodbath, the Peloton story, and it has a tragic and a very dark ending. Stay tuned. But let's start with this. Remember a while ago when Peloton was a hot stock, one of those so-called stay-at-home stocks, the pandemic winners, one of the poster boys of this bubble that is imploding, by the way, right now as we speak. But back then, when Peloton was riding hot, it did not make sense to rational market observers like us, like me and you. But oh, it made a lot of sense to the insiders, the pumpers, and the media who were buttering up retail investors to buy this disaster and walk right through the slaughterhouse. And of course, the retail crowd, the zombies that they are, they buy anything, and they bought into the Peloton story. They dismissed all the valid criticism that came from our side by saying that Peloton is not a bike company. You boomer, you perma-bear. Peloton is a software company. It's a tech company. It's revolutionizing home fitness. And I'm like, wait a minute, I thought Jane Fonda revolutionized home fitness. I mean, we had bikes for a long, long time. So what revolution are you talking about? But these Wall Street, Hollywood, Silicon Valley types, they get excited by anything and they sell it as the future. It's the future. It's how we're gonna live. Like the metaverse, which is a scam, by the way, just so you know. But they keep pumping these things as the future, the future, the future. And the retail crowd falls into the trap and they end up holding the bag. The same story in the 1920s. The same story after the implosion of the dot-com bubble and after the crash of the real estate bubble back in 2008, 2009. It's the same story over and over and over again. And the reason is the retail crowd is not aware about a simple thing that we call valuations. Stocks are not a video game. They certainly can act like a video game for a little while. The irrationality can last for a long time until it doesn't, because valuations always matter. And of course, they're not going to teach you valuations in college. They want to keep you dumb, because the dumber you are, the richer they get, as you will see from this Peloton story. But I started criticizing Peloton in 2020 when it was riding hot. And even back then, in September of 2020, I said the valuations of Peloton is absolutely ridiculous. And back then, Peloton was at only $24 billion market cap, which at the time was bigger than every single operator in the airlines industry. And that didn't matter. The mania continued. They continued to pile in, buying Peloton, pushing the valuations north of $30 billion for a bike company that doesn't make anywhere near $30 billion. And it wasn't just the valuations that I was critical of when it comes to Peloton. There was another fundamental reason that I talked about numerous times in this channel. Take a listen. Because here is a company that benefits from the have and have-nots economy that we have these days. You've heard the earnings from Restoration Hardware, a company that caters to the haves. These companies have no problems whatsoever until they become overvalued. And this is the case of Peloton. Their customer base is a small niche of wealthy people who can afford $4,000 or $5,000 bike. And that's what it is. It is a bike. And of course, they buy it sometimes not just to exercise, but to go with their friends in the Hamptons and say, oh, my Peloton, did you see? Oh my God, so amazing, that Peloton. It's now becoming a status thing for these morons. Once you reach full penetration of this very small, tiny niche, your next avenue to create revenues to milk them for more cash by offering subscriptions and more accessories and products. And of course, I've heard a lot of stupidity today with people comparing, oh, the Peloton valuation is justified because Peloton is just like Netflix. How stupid can you be? Netflix has an appeal and an entry price of about $10 that can appeal to a wider mass of population. You're comparing $10 subscription versus a $5,000 plus bike. Are you insane? And of course, when you look at the valuation of Peloton, it is at $25 billion approximately when you compare it and illustrate it side by side to the valuations of the entire U.S. airline industry. Peloton is now bigger than any U.S. airlines operative. And I know that the airlines are in trouble etc., etc. But the asset value alone in airlines, the value of their jets eclipses all the stupid bikes that Peloton has. Yet somehow Peloton is valued ahead of all these airline companies. This is the mania, the froth in the market that is not out yet.
Well, listen, with all due respect to Kramer, I like to make my own determination of when to buy. But why Peloton? First, because Beyonce, right?
Moving on to Beyonce. Yes, Beyonce. Why are we talking about Beyonce? Because Peloton shares were down about 6% today until we heard that Peloton is partnering with Beyonce to produce content on the platform of Peloton. And you saw the shares recovering and even gaining about 5% or so. This is, of course, the new generation of donkey investors who invest based on this crap. Stock splits, collaboration with Beyonce, Michael Jackson endorsed something out of his grave, and you see pops in these names. Never mind the obscene valuation or the rotation that is going on in the market, the Robin Hoodiots invest based on these kind of headlines. Now, what happens when you're a company like Peloton, which offers $3,000 bikes and have a very small niche of consumers? Once you sold all the bikes that you can, which Peloton seems to be at that point right now, you have to juice them up for membership fees and more crap that they can buy from the screen, more classes, etc. And to encourage that kind of behavior, Peloton needs to shell more money. They need to borrow more money, interest-free money, that was printed out of thin air, by the way, and they shower Beyonce and The Rock and whoever else with that kind of money, just like Netflix is done. And this is how the rich gets richer. Free money printed out of thin air all of a sudden find their way in their pockets. And if you think that a collaboration with Beyonce all of a sudden help a company that reached the ceiling in its growth to grow again, you probably have your head buried deep in your ass. Because the challenge for Peloton is the barrier to entry for consumers. The entry price is so expensive. You're not talking about an iPhone that costs $1,000 and a phone is a necessity, unlike a bike. You're not even talking about Netflix, where the entry price is $13. And of course, to me, this was a gift to short. And I started shorting Peloton since September 2020. And the higher the stock went, the more excited I became. And I started shorting even more because the fundamental reason was clear. You have a company that produces really expensive bikes that the majority of us cannot buy. You're talking about $3,000, $4,000 bikes. To begin with, biking is a niche. Not everybody's into biking. I'm not. So this company from the get-go, right off the gate, was not appealing to a wide audience. The bigger the audience you appeal to as a company, the more attractive you are in the stock market to the public. But a niche company should have never been listed in the stock market because the growth is limited. You have a target, a niche of high-income individuals who happen to be into fitness, and not just into any kind of fitness, specifically into biking. Your audience is a niche within a niche within a niche. What happens if you sell all of them bikes? What happens after that? And what the pandemic did is front-loading all of that consumption in about a year or two. So what happened is Peloton sold all of these bikes to the majority of that audience, the very small niche audience. What happens after that? What are the growth prospects after that? You say it's going to be a streaming company, a content producing company. To who? To the niche within a niche? Within the other niche, it was absurd to begin with. The only avenue for growth after they sold all of these bikes to the majority of the targeted audience is to juice them up via subscription fees, accessories, yada yada yada. Which means that the growth in Peloton was like an arc. And we have already reached the peak, and there is no other room for growth after that. Peloton already reached its growth ceiling, and there is no other avenue for growth after that. Everything else will be smaller when you pin it against selling the actual product, the bike, that costs $3,000 to $5,000. This company should have never been listed in the stock market. Never. Because by listing this company as a stock in the public market, it acted as a pyramid scheme. The stock can go higher so long as the public is buying. But then, the executives realized they reached peak growth, they sold bikes to the majority of the audience, and now what? So they, at the top of the pyramid, they get to dump, leaving everybody below them holding the bag. And the warning signs were out there. The signs that this was a pyramid scheme were out there in the open. The clearest sign was the overspending on steroids, paying celebrities like Beyonce to market Peloton products and paying Taylor Swift to produce content for Peloton. And again, if you've been watching this channel for a while, you know that I'm a big Taylor Swift fan. But you gotta pay her gazillion billion dollars just to wake up from bed. And the question should have been, why is a company drowned in debt with limited growth prospects, an insane valuation, why is this company spending millions of dollars on ads? And most of them, by the way, failed ads. One of them went viral for the wrong reasons. And then what do you know? Mr. Big gets whacked. They hire him. They probably paid him hundreds of thousands of dollars, if not millions, to do an ad. And what do you know? Mr. Big gets whacked again. This time in real life. Peloton should have spent the millions of dollars on reducing their costs to appeal to a wider audience or to innovate newer products. Instead, they spent millions and millions of dollars on frickin' ads. Another obvious warning sign was the fact that people are going to go back to the gym sooner or later when the thing is over. And we already started to see that trend of slowing down in sales of Peloton, the supply chain woes, the bikes are stuck at the port, they oversupplied, and now the demand is down as more people go back to the gym. And on top of that, Peloton hired McKinsey, paid them millions of dollars to figure out why they're wasting millions of dollars. The warning signs were already there. The morale at the company was at all-time low. They were planning layoffs and store closures. Everything was set up for this company to crash. And then today came this.
I want to call your attention to shares of Peloton. We have some significant breaking news regarding this company, and you can see that stock down 10% on word that it plans to temporarily halt production of its bicycles and treadmills as consumer demand wanes, and the company is looking to control its costs. That is according to internal documents obtained by us, by CNBC. In a confidential presentation, the company said demand for its equipment has taken a significant drop due to price sensitivity and increasing competition.
And in all likelihood, Peloton will crash down to zero and it will be delisted from the stock market. If you are feeling bad that you bought Peloton or you're holding a bag, rest assured you're not alone. Somebody else bought right close to the top, and that somebody is Tesla witch Cathie Wood. That's the next shoe to drop, ARK Invest, the next one to crash. And I warned you about Cathie Wood, even back then. Do not follow what she's doing. She's buying Peloton. She's catching a falling knife. She has absolutely no clue what she's doing. She's a glorified gambler, and that's all there is. But there is a tragic, a dark element to the story. It's not just the rise and fall of Peloton and the billions and billions of dollars of retail investors' money that are lost. It is who they lost the money to. And this is the most tragic element of the story. The fact that corporate executives, the CEO and his buddies, dumped hundreds of millions of dollars of Peloton stock right at the top. They knew what was going on. Take a look.
Peloton shares have plunged over the past 6 months. They're now about $30. And the market cap's $9 billion. At $170 a share, it's just amazing how things seem to make sense in a given period where you are, but they really didn't. Some executives, it seems like they knew this, or they had some very well-timed scheduled sales because they avoided the big drop. Robert Frank joins us now with more. I would say well-timed, but any time in the last year has been a pretty damn good time to sell, Robert. But anyway, take it away.
Yeah, you're right, Joe. It's not necessarily unique to Peloton, but Peloton shares falling another 3.5% yesterday, down over 80% from their peak last year. But as you mentioned, Peloton executives selling about $500 million worth of shares, all before that big drop. John Foley, the company's co-founder and CEO, sold $119 million worth of shares. That was between the end of 2020 and the fall of 2021. Most of those sales were for about $110 a share or higher. They now, as you mentioned, trade at around $30 a share. Peloton did not respond to requests for comment, but according to SEC filings, Foley started a pre-scheduled selling program in September of 2020 for, quote, personal financial management purposes. The plan called for selling 2.4 million shares through October of 2022. So far, he has sold just over 1 million shares, with his last sale finished last August. Other Peloton executives also cashing in closer to those highs. all through selling programs. The chief legal and culture officer sold over 90 million in shares, the chief product officer over 60 million, and the COO 28 million. Total insider selling last year was $496 million. So that's a lot for a company of this size. Almost all those sales, again, were at stock prices over $100, which in the rearview mirror looked very smart timing. Joe?
Yeah, well, 50 billion was a lot for a market cap for this company. That's for sure. Andrew, you had a Peloton. I know you.
I've got the Peloton Tread, and I love my Peloton Tread. But Robert, the question I have about these 10b-15 plans is, has anybody ever thought about saying the rule is you can sell on these certain dates, but you can't cancel your sale? And one of the things that I think people do use it is to sort of schedule these sales, and then they cancel when it works for them, and they don't when it doesn't.
You're absolutely right, and that is a great point. I'm surprised, and it would be interesting to see if the SEC starts looking at how much flexibility is in these plans that are always sold to investors as just prescribed, so therefore shouldn't raise any eyebrows. When you looked at the sales in Peloton, you looked at not only some people sort of pausing their sales at certain times, but also escalating them. So it seems like they can not only decide, well, I'm going to end it here early and then restart it again, but also change how much they sell as long as they give advance notice. So this is something perhaps the SEC will look into.
And you might ask, where is the SEC? The answer is the SEC remains in a coma, and the market is becoming a Ponzi scheme. Companies that should have not been listed in the stock market are being listed. Companies are IPOing at insane valuations that don't make sense at all. The market is becoming a tool for Wall Streeters, insiders, the Silicon Valley types, to take advantage of the naivete of the retail mom-and-pop investor crowd. In essence, it is a transfer of wealth from the poor, the middle class, who are chasing the lottery ticket, to the rich and corporate insiders. The CEO of Peloton walked away with hundreds of millions of dollars. The retail crowd is going to lose it all. And this is the tragedy of the stock market right now. And it is not limited to Peloton, by the way. It's all over the place. Look at what happened to Netflix, for example, after the bell. Down 20% at a minimum. A company loses 20% in a single day, 20% of its value. Peloton lost a quarter of its value today alone. It is a bloodbath in the market, and we have to sober up. We have to wake up from the pipe dream, the mania of this bubble, of buying stocks with no regard to the fundamentals, the valuations, and the logic. Regardless of the subscriber growth in Netflix, for example, the stock is down big after hours. And if it opens like this tomorrow, the stock will be down over 40% from the top in a matter of weeks. And it will stand to lose all of its pandemic gains. It will go down to the same level it was trading at in 2018. We are now starting to question the business models of these companies. You see, in the era of the loose, easy money policy by the Fed, printing money all over the place, it creates an illogical, irrational market where investors' money chases growth at any cost, regardless of valuations, regardless of merit, regardless of the logic. That works until it doesn't. Take, for example, Netflix. They have a subscription model. You pay $10-15 a month, and you get to watch all kind of content for free. It almost sounds too good to be true, but it worked in the easy money policy era. Netflix took a lot of debt penned against their equity value, and they expanded more and more and more. But there is a ceiling at some point to this growth. What happens, let's say, when every human being on the planet is a Netflix subscriber? What happens after that? Where does the company grow from that point on? And their growth is actually limited. It is shrinking in North America, Europe, but it is growing in Asia, Middle East, South America. So what they're doing right now is attempting to appeal more to that audience, where the growth is Asia, South America, Middle East, by producing content that appeals to that audience. Yet the purchasing power for the majority of that audience is limited. It doesn't match the spending and purchasing power for European, American, and Canadian consumers. And therefore, they're jacking prices on US and Canadian customers to subsidize the production for international content that appeals to Asia, Middle East, and South America. And they're hoping that some of that content will be a hit, like Squid Games, for example. But in reality, it's not going to happen. Once in a while, you're going to have a global hit. But in doing so, you're creating less value for the North American consumer, where I'm not getting content that I really like on Netflix for weeks and weeks. I have to wait weeks, sometimes months, before I get something that I like on Netflix. In the meantime, why am I paying them? And therefore, you're seeing a lot of subscribers who are freezing their payments until they get something they like. This is not a sustainable business model. It is if you're not a publicly listed company, but for publicly listed companies, the whole idea the stock market is growth, not stagnation. And now we're seeing investors waking up to that fact. And it's not just going to be Netflix, by the way. Every company that ran high in valuations, specifically due to transitory reasons, meaning the pandemic and the stimmies, they're going to face the same fate. And my advice is, we got a lot of earnings this week. Look at companies. Look at the results. And we cover these results pretty much every single day in this program. Look at companies with the pricing power in this inflation and with a receptive consumer. These are the companies that are going to fare better than the rest. And if you watch the video that I made a few days ago about the consumer, you know that the consumer is running out of spending power. The economy is about to slow down dramatically. We have no guarantee here that inflation will also slow down or not. We could face a stagflation phenomenon. The consumer has already exhausted the stimmies. That's stage number 1 of spending. Stage number 2 is savings. Consumers already exhausted their savings. The household saving rate is now below the pre-pandemic reading. Stage number 3 is credit cards. And the consumer is racking credit card debt like never before. What happens after that? What will sustain the growth in these companies at the same level when the consumer is running out of ammo? And therefore, the message is, stay away from any company that relies on the consumer directly. Stick with companies whose customer are either governments or other corporations. What do I mean by that? Take, for example, some of the earnings that we got this week. We got American Airlines today, and American Airlines is losing almost $1 billion in a single quarter, which was supposed to be one of the hottest quarters for them. But this is a company that caters to the consumer directly. The consumer has to fly during the holiday season, but they don't have to after that, specifically in this pandemic environment. On top of that, they're running out of cash. So you got to stay away from these companies. On the other hand, take for example Alcoa. Alcoa reported earnings, and the earnings are solid. They're still growing. They're still a beneficiary from this inflationary environment. Aluminum prices are moving higher. The demand is sky high, at least for now. And the end consumer for Alcoa is governments and other companies. These entities still have the spending power, and therefore Alcoa is faring a lot better than other stocks. So I continue to hold on Alcoa, for example. Another one. Today we got earnings from Union Pacific. Railroads are classic inflationary stocks because they transport goods, and it doesn't matter. If you want your goods to be transported, if there is inflation, you got to pay them more. And Union Pacific is jacking prices higher. Now, who is the end consumer of Union Pacific? It is oil and gas companies transporting these products. It is big farming companies producing grains and transporting those grains across the country. It's Amazon. It's automobiles manufacturers, etc., etc. These entities still have the spending power. Whatever Union Pacific asks for in terms of prices, they're gonna pay. The story is different when it comes to us, the consumer. We're gonna run out of spending power after the credit cards are maxed out. What happens after that? And yes, if what I'm seeing right now in the economy turns out to be true, the economy is about to slow down dramatically, the Fed is about to raise interest rates to battle inflation, and the economy will dip into a recession, a big one. And when the stock market starts to crash, as a result, we will see a lot of job losses. And when that happens, even companies like Union Pacific and Alcoa will also get crushed. There is no escape here, but there are corners that you can hide in the meantime. The bottom line is, as an investor, you have to be disciplined, you have to have principles, and invest based on those principles. Once in a while, we have bubbles and manias in the stock market. And yes, these are opportunities that you don't want to miss. You can participate in them. Your participation has to come with the mindset that these are products of a mania. It is a mania phase that will come to an end, and therefore you invest in these companies accordingly. You buy them while they're hot, they go insane, you take your profits, and you thank the Lord, and you move on. But your investment, your core investment portfolio has to be built based on the fundamentals. If you are just chasing the hot item, the hottest stock for the week, for the month, for right now, your investment journey will end in a disaster because there are a lot of predators out there. Look no further than the C-suite of Peloton. You really think they were not aware about where the company is going when they dumped hundreds of millions of dollars and they cashed out? Of course they did. And this is one of the main reasons I started this channel, to be an advocate for retail investors, to help them avoid and see these scams and build their investment portfolios based on discipline and rationale. Yet this channel gets attacked over and over and over again. I get accused of being a perma bear, yada yada yada. When all along, I was just looking out for the retail crowd. If you want to help me to spread that message out, please press the like button and engage in the comment section. That helps us with the algorithms. Anyhow, let's move on to cover the market information today, starting with the performance. And here we go. The Dow Industrial Average closed in the red, down by 313.26 points, or a loss of 0.89%. The Nasdaq down big, 186.23 points, or a decline of 1.30%. The S&P 500 down by 50.3 points, or a decline of 1.10%. Nasty, ugly closing once again, reversing all of the gains that we got in the morning. Very ominous sign here. And what about the sector's performance today? Bloodbath. We're not giving away any metals today because only utilities barely closed on the flat line. The rest of them got whacked. The laggards of the day were led by materials, cyclicals, and energy. Nothing is working today. It's a bloodbath. What about the advance to decline ratios? NYSE 20% advancing versus 77% declining. The Nasdaq 27% advancing versus 69% declining. Now, if you've been watching the channel for a while, you know that when we see these exaggerated numbers to the downside, exaggerated ratios, I should say, to the downside, it is usually, not always, but usually, an indicator that we're about to see a rebound, at least in the pre-market session. But we saw that happen yesterday, and the rebound failed miserably. And therefore, I say, the market will only bottom, a legitimate bottom that we can trade for at least a few days, if not weeks, if the market has a nasty opening, meaning gapping down. The Dow is down 1,000 points. Everybody's panicking, high volume, and then we see a rebound midday and closing off the lows. Now that would be a reliable bottom, not the gap and crap that we got today. Moving on to commodities. What's going on here? Energy were trading higher, at least early in the morning. And then by the end of the day, they turned negative along with the stock market. Oil is down, Brent, WTI all down almost 1.5% apiece. Gasoline was also down along with heating oil. So was natural gas, and we continue to watch natural gas carefully due to the tensions between Russia and Ukraine. We will also have to watch the weather because temperatures are getting colder in the east and the south. When we talk about Texas, for example, the headline reads, bone-chilling temperatures and north winds headed for Dallas-Fort Worth with Arctic front. So if you're in Texas, you're probably freezing in nuts right now. And it's not just Texas, by the way. Temperatures are dropping below normal across the east and the south. And the problem with Texas right now is the fact that the production of natural gas is actually dropping, along with temperatures that are plunging into freezing, as if we've never learned anything from last year, the deep freeze in Texas. Now, this is not anything like it. It's not as extreme, but it remains a source of concern. Why isn't Texas producing more natural gas right now? Back to the futures. What about softs? Lumber continues to ease here, down over 3.5% today alone. We also have losses for cotton, sugar, and coffee. On the other hand, cocoa pretty much in the flat line, but we have modest gains, almost 1% for OJ. On the other hand, the rally in metals continues, with a notable absence from gold. Gold traded down today, slightly, modest losses, pretty much in the flat line. Yet we had big gains for silver, platinum, copper, palladium, all trading higher. What about meats? Muted activities for live and feeder cattle futures. On the other hand, lean hogs, the new big tech. See, tech is down, lean hogs up. You do the math. But lean hogs futures closed higher by more than 3% today. What about grains? We have gains for soybeans. There is a reason for that. We'll discuss it in a second, but soybeans up, so is canola and rough rice. On the other hand, corn pretty much in the flat line, yet we have losses for oat and wheat futures. Here is the story with soybeans. The production from Paraguay turns out to be the worst harvest in almost 2 decades. So again, the message to Jerome Powell, buddy, you're not just facing monetary inflation, you're facing the weather phenomenon, the pandemic, the labor shortage, and many other factors. It is the mother of all storms of inflation altogether. And as you can see, the production from Paraguay in yellow, the projection is it's going to be down big. And even in Brazil, which is way larger than Paraguay in the production of soy, the USDA also estimates that the production from Brazil will be down this month. And this pushed soybean futures higher today. Moving on to the big casino, the options market. What's going on here? The hottest table by far remains Apple at 1.2 million contracts traded today. About 57% of those were calls. And at number 2, Ford, with almost 1 million contracts traded today. About 58% of those were calls. At number 3, Tesla, the souffle, with almost 700,000 contracts traded today. About 52% of those were calls. Notice that the volume is down all in all. We're not seeing millions of contracts like we've seen before. You can go back just a few months ago. The options volume for Apple, for example, exceeded 3 million contracts per day. This is yet another sign that either the retail crowd is already holding the bag and they're not gambling on options anymore, who's going to support the market higher without options gambling, or the retail crowd, the mom and pops, are waiting on the sidelines for now, and everybody's scared and waiting for a better opportunity to move back into the casino. What about the unusual activities that we got today in the options market? We start with the ticker SNAP Snapchat. We have a put spread here. They're buying the 33 puts and they're selling the 27 puts, all for the expiration date, March 18th, with expectations that Snapchat will drop by more than 5.5% by then, but not more than 23% by the expiration date of March 18th. They paid about $3 a piece for the 33 puts that they bought, and they received about $1 a piece on the 27 puts that they sold. All in all, reducing the entry cost to about $2 a piece. All in all, spending about $3 million. What about the trade for the ticker GM, General Motors? They're betting for more upside here, buying the $60 calls for the expiration date April 14th, with expectations that the name could pop higher by more than 10% by then. They paid about $2.35 a piece to enter this trade. All in all, spending about $2.8 million. What about the trade for the ticker QQQ, the Nasdaq? The buying calls here, betting for a rebound, the 390 calls, the expiration date February 2nd, with expectations that the name could pop higher by more than 8% by then. They paid about 35 cents a piece to enter this trade, all in all spending about $300,000. And what about the trade for the ticker GLW? And this is for Corning. Again, who is the consumer, the end consumer of Corning? The answer is it is smartphone manufacturers, Apple, Samsung, etc. So once again, these kind of companies will fare better than companies that target the consumer directly. Soon enough, who is the end consumer of smartphones? If the consumer is about to weaken, they're not going to buy smartphones. If they're not going to buy smartphones, then the providers of smartphones, Apple and Samsung, will reduce their spending buying products from Corning. So soon enough, the feedback loop will come around to bite these companies in the ass too. But at least you have a window of time before that happens, versus companies that target the consumer directly. Anyhow, here's the trade. They're buying calls on GLW, the 37 calls, with the expiration date March 18th, with expectations that the name could pop higher by more than 5% by then. They paid about $1 a piece to enter this trade, all in all spending about $850,000. And what about the trade for the ticker AA Alcoa? I love the name. I've owned it for a while now, and it remains a top performer. At least for now. In this inflationary environment, you want to be in Alcoa, not in Snapchat, Netflix, Peloton, all of that garbage. Anyhow, they're buying these 65 calls on Alcoa with the expiration date April 14th, with expectations that the name could pop higher by more than 6% by then. They paid about $5 a piece to enter this trade, all in all spending about $3 million. Lastly, what about the trade for the ticker SMH? This is the CHIPS ETF. And this is highly interesting that they're buying puts on the SMH. I believe that chips will be an underperformer this year, and the reason is they ramped up the supply so much that by the time this supply hits the market, it will no longer be needed, and the market will be oversupplied, and these companies will end up holding the bag. This is what happens when you solve the inflation problem by ramping up supply, because by the time supply arrives to the market, it's already too late. And hence, we've been saying all along, Mr. Powell, you gotta start adjusting the monetary policy so you can tackle this inflation problem via the demand. That would have been the healthy way to tackle this inflation. Now it's already too late. But anyhow, back to the trade. They're buying the 245 puts for the expiration date, April 14th, with the expectations the name would drop down by more than 11% by then. And they paid about $7.50 a piece to enter this trade, all in all spending about $4 million. Moving on on to the heat map analysis. What's going on here? A bloodbath across the board. I can't sugarcoat it for you. Chips down, tech down, consumer cyclicals down, consumer defensives down, utilities on the flat line, but not impressive here. Energy down, metals down, industrials down, financials down, you get it. Everything is down. Few pockets are performing here and there. Morgan Stanley ahead of time, they shorted the name assuming it's going to go down, like Goldman Sachs and JP Morgan. Now they're covering. The Chinese stocks are catching a bid. Another stock that caught a bid today is Sony. You see underneath Apple, there was a rectangle in green. That is Sony. We talked about Sony yesterday. The bet was that it's going to bounce from the 200 days moving average, and indeed it did. The sell-off was overdone. Sony is not an overvalued company. And oh, by the way, Activision Blizzard will still produce video games to Sony's platforms. And I bet, by the way, when the market turns sour and the stock of Microsoft takes a nice haircut, they're going to dump this deal and walk away. It's not going to happen. Another mover is Luminar, the ticker LAZR. We saw some unusual activities in the options market yesterday. You can go back to the video and see that trade for yourself. And now we know why. We have news from Mercedes. They have a new partnership with Luminar to supply sensors. But on top of that, Mercedes also bought a stake in Luminar. If you've been watching this channel for a while, you know that I'm a fan of Luminar, the company, the product. Not so much the stock, although there is a case that you can make to justify the valuations of Luminar right now, but it depends on more adaptation, not just from one manufacturer, but from all of them. If Ford, GM, even Tesla start using Luminar's products, then the valuation of the stock is justified. We also have bad news for steel stocks, and they were down big today. The North American steel market is in for some rough months ahead, with excess supplies, rising inventories, and shrinking demand, according to Stelco's top executive. And they warn from catching a falling knife, and therefore I sold all of my steel holdings today. They're gone, poof. And I believe that this story will be replicated across many other pockets in the economy. We will find out that the market is now oversupplied and the demand is nowhere to be found because the mania is coming to an end. The loose money is coming to an end. When folks start to see their stock market and crypto gains evaporating, they start to become nervous and they stop the mania out of control spending. And soon enough, when the stock market crashes, they lose their jobs. When that happens, they're not going to spend at all. And now, you have all of these supplies to catch up with the outlier demand during the pandemic, and you end up with the supply-demand imbalance the other way this time around. So watch out, the economy is about to sour dramatically from this point on. And yes, you could say the same thing about copper, but copper is more resilient than steel. Steel depends on the Chinese market a lot, so does iron. And I avoided iron from the get-go, and now I'm cashing my gains in steel. Copper, maybe a few months from now, I will dump copper, specifically Freeport-McMoRan, that I own right now. But the message is clear. Even these inflationary stocks, there will come a time, and that time could be soon enough, by the way, where they're not going to work anymore because the economy is going to sour and we will have very few pockets, if any, that are going to continue to work. At some point, we're going to have to shift strategies. At least in my portfolio, there will come a time really soon where I'm going to have to shift strategies to become 100% short instead of the long-short portfolio that I have right now. The ratio will be adjusted, more shorts than longs, and soon enough, 100% short. Let's move on to the ETF heat map. What's going on here? Everything is down, even the XOP, XLE, XME, materials, energy, cyclicals. Nothing is working today. Even gold is down. The only thing working are the inverse indices, the SQQs, the TZA, the SOXS. When we look at the international markets, for example, Chinese ETFs are working, the FXI, the Brazilian ETF also working, the EWZ, emerging markets ETFs are working today, not by a lot. Silver continues to outperform. And by the way, when gold and silver outperform, it's not a good sign. For now, we're having silver consistently outperforming, gold not so much. But I bet soon enough, when we look at the pockets to hide in this market, we're not going to hide in tech, we're not going to hide in growth and momentum. These are the stocks that are getting crushed right now. For now, I'm hiding in the inflationary stocks still, the value stocks, but soon enough they're not going to work too. So where do you hide? Perhaps gold and silver, that's an option. Anyhow, we're moving on to the charts analysis, starting with SPY, the S&P 500 30 minutes chart. What's going on here? Nasty, ugly closing, absolute bloodbath here. They gapped higher in the morning, going all the way to 459 as resistance, sucking a lot of bulls, a lot of dip buyers in the process, and then flushing them down in the most brutal fashion ever. The flush down did not stop until the bell. Unbelievable. And the chart stopped pretty much at the last support that I have here at 447 and actually closed below that. And does it really matter if we point out the next support? The chart's not going to respect any support right now. It's going to bottom when it wants to bottom. We're still waiting and waiting and waiting for a reversal. But before we do that, we need to find a bottom. We're not finding a bottom right now. And in my opinion, the market will bottom when we have an ugly opening, a bloodbath, open the gates of hell kind of opening. When you have fear, the Dow is down 1,000 and then it catches a bid. That will be the bottom. But for now, it doesn't matter from which support line it's going to happen. We zoom out to a daily chart for the continuous contract for the SPY. What's going on here? We're waiting for the 200 days moving average, but does it really matter at this point? You saw what happened with the NASDAQ. It caught support from the 200 days moving average. That produced a dead cat bounce, and the rest is history. And now you know why I don't use moving averages. They're useless to me. Yes, the algos react to them at the moment, but then they ignore them right away. So some of you ask me, hey, what about the 50 moving average, the 150, the 200.5? Who cares? I care about the RSI, the MACD, and the support lines that I have. The trend lines, they matter. The moving averages, not so much. But the bottom line is, the selling is happening on higher than average volume. The momentum indicators remain in negative divergence. We're getting closer to quote-unquote oversold readings, but we're not there yet. Perhaps another nasty flush down would do the trick, but until then, the bears remain in charge here. The next support that I have is around 4,384.5. We'll see if that holds or not, but again, I'm not looking for any of these lines. I'm waiting for a sign that the market has bottomed, at least for a few days or perhaps weeks. And that's not going to happen until we get one of two things. Number one, the nasty, ugly gap down opening with higher volume, and then a reversal and closing off the lows. That's number one. Number two, if the fundamentals, meaning earnings, specifically from the big cap technology stocks, come out pristine, then the market can find a reliable bottom. What about the Qs? 30 minutes chart. What's going on here? What a beating. Unbelievable. Gapping higher, recapturing 372. A lot of bulls got sucked in here, buying the dip. Assuming that we're out of the woods, the 200 days moving average is working. They buy calls, they buy the Qs, they buy stocks. What do you know? They flush them down all the way till the end of the day. It's a ride of pain. Not for the bears, though. We're below the support of 363. We're now looking down at 360.5. But again, does it really matter? What numbers are we looking at? What support line are we looking at? Doesn't matter. We are in a flush down. In a flush down, the support lines don't matter anymore. You gotta wait for the chart to show you the bottom and show you a clear sign of a reversal and a confirmation of that reversal. You combine that with the other indicators, the bond market, the VIX, the VXN, and the picture becomes clearer. The problem is, we're not there yet. Here's a daily chart for the continuous contract for the NASDAQ. Oh boy, look at that. Way below 15,000 now. Even 15,000 didn't hold. Like I said, they're not going to matter. These support lines, which acted as strong resistance, strong support before, the flush down is not respecting any of that. There was only one direction that the chart is heading to, and it is south. So you got to wait till the chart bottoms. It didn't hit ground yet. Where is ground? Who cares? Who cares? We'll find that when we find that. But for now, the bears remain in charge. The selling is happening on higher than average volume. The momentum indicators are all in negative divergence. They're about to get oversold, but we're not there yet. If you still want to identify a support line, we can identify somewhere between 14,000 and 15,000, which happens to be 14,445. This level acted as solid resistance and solid support before, multiple times. So let's see if we can get a rebound from that level. But for now, we're moving on to the 30 minutes chart of the IWM, and ooh, what a beating. What a beating for the IWM. Crashing through all of these support lines like they didn't matter. We're now below 204.5. Where is the next support, you might ask? Again, it doesn't matter, but I have 196.5. For now, we gotta wait for the chart to find the bottom. It could be a long way from here, by the way, because here is the weekly chart for the RUT, the Russell 2000, the big one. We have one day to close the week. And this is a weekly chart. The weekly candle is below the line in the sand, 2100. It means that the mania is over. We're about to see the crash, not the correction, the crash of the IWM, the Russell 2000 soon. So whatever happens here, if we see rebounds, all of these rebounds, you can play them as a trade. But the mentality from this point on is sell the rip until the fundamentals change. And that is, by the way, applicable to the NASDAQ, the SPY. Yes, we're looking for a bottom. We're looking for a rebound. We're looking for a rally for about a few days, maybe weeks. Yet at the end of the day, if the monetary policy remains the same, meaning the hawkish stance continues, and the economy continues to slow down, on top of that, then we have a long way to go to get back to rational and reasonable valuations in the stock market. Moving on to the Dixie, the dollar index, what's going on here from a daily chart perspective? It appears that the Dixie is attempting to recapture 96 as support before the end of the week. Could it happen? It depends. But what we're seeing in the RSI and the MACD indicator is encouraging for the dollar to recapture 96 as support. We have a negative divergence still, but it is reversing. The indicators are curling higher, and we're about to have a confirmation on the MACD indicator on the daily if it crosses the positive territory, showing green impressions on the histogram. Then this is a confirmation that the dollar is about to recapture, or perhaps already recaptured, 96 as support. And notice how long the MACD indicator has been in negative readings, producing red impressions on the histogram. It has been at least since December. Yet the pullback in the dollar was minuscule at best. What does that mean? The dollar remains strong. The tailwinds for the dollar remain here. And a higher dollar is not good for multinational corporations. You might see in certain earnings that the currency impact is so severe to the point where it impacts the top and the bottom line of certain companies. Moving on to gold, what's going on here? Still trading above the three amigos. It is still bullish for now, but why the absence when silver is moving higher? The only plausible explanation that I have is the fact that retail is now moving the silver. Silver is cheaper, it's easier to trade than gold, and perhaps that's the explanation between the divergence between gold and silver. And it's not really a divergence, it's just gold lagging silver. They're both moving higher, but gold is lagging silver for now. Moving on to the 10-year yield, what's going on here in the daily chart perspective? It was a down day for the 10-year yield, yet the NASDAQ flushed down. In essence, the market is not believing the action in the bond market. The market says, I don't think that the 10-year yield topped for now. Even though we have a topping candle, we have a confirmation. And oh, by the way, the momentum indicators are all quote-unquote overbought. They're waiting desperately for a pullback. What if the 10-year yield loses support from 1.77 and it goes all the way down to 1.7? Could we at least have a relief rally in the NASDAQ? That could be the case. And here's a weekly chart for the TLT. Again, it's a positive candle. It's moving a little higher, supporting the fact that the 10-year yield could continue to pull back, and perhaps the NASDAQ could finally get the message and start to move higher in a rebound rally. The problem is, you look at the weekly chart, the negative divergences and the negative readings in both the RSI and the MACD indicators are just starting. What does that mean? You can see bounces on the daily, but the weekly chart of the TLT is saying the outlook remains the same. The TLT will go down, the 10-year yield will continue to move higher, which means, for now, any rebound in the NASDAQ is an opportunity to sell the rip. Not necessarily right away. You have to combine all of these indicators together and then figure out when to short the rip. With that being said, between you and I, you probably already know that if you've been watching the channel for a while. I've already been shorting the NASDAQ since December, so I've been riding this wave to the downside since then. And I'm now waiting for a rebound rally, a legitimate rebound rally that lasts for perhaps days or maybe weeks, because the implied volatility in puts, these premiums are moving higher, which makes the risk versus reward not worth it. You're going to pay a lot for these premiums, and the majority of the juice is already squeezed. The opportunity, from a trading perspective at least, is contrarian. Meaning, let's say the market opens down big in the morning and we start to see signs of buying, and the selling is happening on higher than average volume. Lots of panic, lots of diapers being changed, right? And then you start buying calls, upside calls, out of the money, and the market rebounds. We're talking about the tech names, the NASDAQ, they move higher. Now a lot of shorts have to cover. You see that massive pop higher. Those call options will appreciate a lot more than you buying puts right now at these elevated premiums and hoping for another 3 to 5% downside. It could happen, but we're weighing the risk versus reward here from a trading perspective, of course. Moving on to the 4 hours chart of the VIX. Here's your indicator. Is it moving higher or to the downside. Look at the MACD indicator from 4 hours perspective. It is moving higher, producing green impressions on the histogram, and those impressions are getting larger, not shorter. What does that mean? The dip in the SPY is not over yet. You're going to see the VIX moving to the downside, perhaps losing 20 as support. And then you can confirm that by seeing red impressions, the histogram of the 4 hours MACD. That's check mark number 1. Then you look at the bond market, the 10-year yield. Is it trading up or down? If it's trading down, then that's check mark number 2. Then you look at the chart of the SPY, the Qs. Is it rebounding? Is it rebounding from a significant level of support? Or is it rebounding from an insignificant level? Is it rebounding on higher volume or not higher volume? If it is rebounding on higher volume, then that's check mark number 3. And now you know you have a tradable bottom. A similar story with the VXN. This is the VIX for the NASDAQ. It's a 4 hours chart. Look at the MACD indicator. Is it moving higher or to the downside? The answer is it is moving higher, producing green impressions on the histogram that are getting larger. And it appears that the VXN wants to go ahead and challenge the previous high at around 36. So again, reading the tea leaves, let's say this scenario happens. The NASDAQ opens gapping down big. The gates of hell, panic all over the place, bloodbath. The VXN opens higher at around 36. And then you see some buying in the Qs, dip buying. And you see the VXN moving to the downside. And then you look at the bond market. Is the 10-year yield moving higher or to the downside? If it is moving down, then the risk versus reward says buy the dip in the NASDAQ, not the VXN, just to make sure what I'm talking about here. Next, we have a daily chart for Apple. What's going on here? The reverse ABC pattern is playing out. The support of 172 is gone. The gap at 165.32 is already closed. We're now reaching the support of the channel. In all likelihood, if that produces a rebound, we could go all the way to retest 172.4 as resistance, but sooner or later, that rebound will be an opportunity to fade, sell the rip, and Apple will go down to the channel. Why do I say that? Here's the scary chart that I did not share with you yesterday. It is the weekly chart for Apple. We have a trading channel, a narrowing trading channel that the stock has been trading within for over a year. Then we had the false breakout, the 3 trillion breakout. When you have a false breakout, you're going to go down to the channel and the actual break will happen in the opposite direction. If that happens, then Apple goes down. As Apple goes, so will the market. What about Tesla, the souffle? This is a 30 minutes chart. Look at this. It moved higher, producing the bull trap, and then it moved down, flushing all the way to the support of 995. Look at how many times the chart has been knocking at the support of 995 with no legitimate bounce produced. You knock once, you knock twice, you knock a third time at a support level. Hello, what's going on here? I supported you once, twice, third time. You did not move higher, then let's open the gates and flush you down. If that happens, then we're looking at the gap at 993 to be closed. Lastly, what about tulips? BTC, what's going on here? It looked in the beginning of the day that it's going to be a good day for BTC, perhaps some buyers stepping in, and then came the flush down. No damage to the formation yet. The chart's still waiting and waiting and waiting for buyers. The longer it waits and buyers don't show up, the more likely the bear flag formation will play out and BTC will flush down. We also have some bad fundamental news from the Bank of Russia, which is seeking to outlaw and ban trading for cryptos across the board. Matter of fact, the Bank of Russia described cryptos as a pyramid scheme, and the threshold for that is the fact that cryptos would not move higher absent of fresh new blood buying these assets. You have to recruit more to push these assets higher. And this is a classic definition of a pyramid scheme. But hey, you don't have to listen to me or the Bank of Russia. You can listen to drunk Michael Saylor, who says that MicroStrategy will never sell its $5 billion crypto stash even if the prices crash. So you can hold the bag with drunk Michael Saylor. I mean, at least he's good company, right? The guy knows how to party. He has all the good drugs. He knows how to drink. If you're going to hold a bag, you might as well hold it with Michael Saylor. The problem is, by the end of the movie, Michael Saylor will be fine, not you though. You're going to be absolutely destroyed. Perhaps it's the deja vu of what happened in MicroStrategy in the dot-com bubble. It is the same story, the same actors, the same scams, with different names. That's all there is. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have leading economic indicators. That's not going to be important because all eyes are going to be on Netflix, Peloton, options expiration. A lot of action could happen here. A lot of traders, a lot of market participants are waiting for a rebound opportunity, which will end up being a bull trap. But in the meantime, if we have a reliable rebound, it could last for days if not weeks, and there is a lot of money to be made from that rebound. Anyhow, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again over the weekend.